Welcome to another episode of Davidov Wealth. Today, my co-host, Ethan Davidov, and we've got a special guest, Ilana Davidov.
Hi, everyone. It's a pleasure to be here.
Yes, attorney extraordinaire.
Very nice having you on today.
Thank you.
Thank you, and congratulations to you. I heard that now for the 5th year in a row, you've been ranked as a super lawyer.
Congratulations to you also. 4th year in a row for you. Also,
thank you.
Best Lawyers 2024-2025 nominee winner over here.
Wonderful. But today we're hosting Ilana and wanted to really get a sense of the kind of work that you do as an estate planning attorney at Davidov Law Group. So, Ethan, go ahead, take it away.
So, can you share a little bit about your background and why you chose to focus on estate planning rather than other areas of law?
Sure. I've been practicing law since 1999. Initially started my career in litigation track, and I quickly realized that was not an area that I wanted to focus on. I wanted to help families with protecting their estate, protecting their loved ones, and making sure that they're avoiding courts and other types of situations.
Sure, I think you've called it doing nice law instead of the kind of litigious law.
Yes, having started out in litigation, I really didn't enjoy the litigious side of things, and I wanted to help families and really do what I called nice law, and being able to help families make sure that things are protected and preserved in the way that they'd like it to be, and make sure that things are simple and easy for their family when they're no longer there.
Okay, and your practice, you started out doing a lot of real estate work initially.
Yes.
And honed into more estate planning work and elder law.
Yes, I think I shifted from real estate to estate planning and elder law in 2008. And I've enjoyed working with families and helping them preserve their estate since then.
So what's made you want to do that shift to begin with? What pushed you away from real estate law and brought you more into the estate planning side of law?
Well, real estate felt like it was much more transactional. I was helping a family when they were buying or selling their house, but I didn't really get to know them on a personal level. When I help family plan their estate, I really get to know everything about them, what their goals and their concerns are, what their worries and their fears are, and make sure that we put a plan in place that protects them. So, for example, today I met with a family who was really concerned that one of their kids was not good with money, and they wanted to make sure that when they left things for that child, that money wouldn't just dissipate, that money would be there for that child for their lifetime and would be protected for their inheritance, for their benefit, and protected from their spending.
So how do you do that? How do you address that?
We address it by really focusing on what's important to the family and making sure that the estate plan, typically in a trust-based plan, is very detailed and covers all of their goals and concerns.
So let's say specifically with the creditors, and what estate planning tools exist to be able to protect a family in that way from potentially having somebody who's not so great with money spending their entire inheritance all at once?
So in those instances, we create a plan for the clients, and when they leave their inheritance to their child, to this child, we leave things in a creditor protection trust where somebody else is the trustee and manages the monies for that child.
Okay, that's smart. And does that come up often, where you have a child who's not particularly good with money? Is that something that's a concern for a lot of clients?
It comes up more than you think. This week I've had 2 families that this was a big concern for. So absolutely.
That's nice. So you're able to protect things.
Yes. Another type of example is when you have a family who has a special needs beneficiary, that they want to make sure that beneficiary is protected, but that they don't lose their government benefits that they're entitled to. And so we also make sure that we're planning in a very particular way and leave things in a supplemental needs trust for their benefit so that it could supplement their care, but not take away the benefits that they so desperately need.
Oh, that's very interesting.
So that what you're saying is that beneficiary, their child or grandchild that they're leaving something behind to, is dependent on some entitlement programs like Medicaid or SSI or something that's giving them a benefit, and that's driven by the amount of assets that you have.
Yeah, so those very special beneficiaries are getting benefits from SSI or Medicaid or other government benefits. And if they inherit funds in their own name, they will lose those very important benefits. But by sheltering and protecting things and leaving it to them in a supplemental needs trust, we're able to enhance their lifestyle with the inheritance, but make sure that they don't lose those very important benefits.
Cool.
Sounds like you're a financial ninja.
We all have our days.
Okay.
So, in addition to the subtrust that you mentioned previously, the one that protects from creditors and also for supplemental needs, you've oftentimes mentioned divorce protection trust. Do you mind just explaining to the viewers a little bit how that works and what that is?
Sure. If you're leaving an inheritance for your child, you want to make sure that that inheritance stays with your child, even if they get a divorce down the line. And so we recommend to many of our clients to leave their inheritance in a trust which has this divorce protection.
So just to clarify, this is not necessarily for people that where they're going through where the kids are going through the divorce process now. It's a precautionary kind of a situation where you're saying, just in case that child gets divorced, I want to make sure that your money stays in your bloodline and it stays in your family, so that it doesn't go to
the divorcing spouse.
To that other.
Is that something that would happen without that type of a trust?
So what happens, unfortunately, is if you don't include a subtrust to protect the children from divorce, unfortunately, when a parent passes away and there's no such protection in place, when the kids get their inheritance, sometimes it's an uncomfortable conversation with their spouse. Hey, aren't you going to put that money into our joint account? Well, that's a tough conversation to have. No, I want to keep it separate just in case we get divorced. The moment that those funds are transferred into a joint account, those assets become commingled and they become marital property. And by being able to segregate them, and the trust, this divorce protection trust, allows us to keep them segregated, then in the event that there's a divorce down the line, then the spouse is not entitled to any of the assets in that separate trust.
Okay, so you're making it actually easier for the child to be able to protect that money and to make that conversation easier for them to have and to say, hey, my parents' attorney, Ilana, set that up that way. That's the way that we've got to follow.
If you have a problem with it, go talk to my attorney. Don't talk to me.
And so absolutely, by having a separate trust for each of the children, that allows us to offer that divorce protection, and the children don't need to have that conversation as to why they're separating their money and keeping it in a separate account. They're able to, in effect, get divorce protection for it.
Great.
So in addition to the subtrusts, what are some of the more complicated estate planning tools that you've used for higher net worth individuals? Either of you?
So I guess I'll take that one. In our estate planning practice, we've used many other estate planning tools besides a revocable or a typical irrevocable trust to protect from long-term care. We've done more complicated tax planning. So often at this point, we might use a gifting trust where we might put the life insurance into that. And that life insurance can be protected from estate taxes, from generation skipping transfer taxes, as well as gift taxes. And so you're using a very efficient way to create generational kind of wealth.
Do you mind going into a little bit more detail on how that works?
Sure. So, for example, I might have $1 million life insurance policy that I decide to go out and get, or maybe I already have it in place. And it's often sold to people where they talk about, well, this is not income taxable to you. But little do they know that it is estate taxable. It will be included in that person's estate. And if you have a large enough estate, it's going to be included in there, and you might lose 40 cents on a dollar of that to estate taxes. So one way to shelter from those estate taxes is you can transfer that life insurance policy, or you could purchase a life insurance policy in a type of an irrevocable trust. In estate planning, we often use acronyms, so it stands for Irrevocable Life Insurance Trust, or an ILIT, and you can transfer it into it. And then the premiums that are due every year to pay for the life insurance policy, those could be gifted into the trust. You would set up a checking account, you would gift the money into it, and so maybe the premiums are $20,000 a year. And you would do that, and then you would give the beneficiaries an ability to pull that money out, which the intention is that they won't do that. And so let's say that your kids are the beneficiaries. They would have a right to pull it out for a limited amount of time, say 30 days. And if they don't pull it out, now you can use that money as the trustee to go out and purchase the premium with it. So you can use that money to pay the premiums. And when the grantor, the person who set it up, passes away, that insurance company is going to pay that $1 million into that trust, but it's going to be excluded outside of that person's estate. And so you can use annual gifting to beneficiaries. Rather than giving them the money outright, you can give it into the trust, which could buy a more significant life insurance policy. And it's a great way to shelter.
Wow, that could save theoretically hundreds of thousands or millions of dollars.
Yeah, we've had clients where we've been able to save them millions of dollars in that way, because the life insurance is significant, their estate is significant, and so every dollar there can save quite a bit for their family. So that's one example. Another example, which is something that we've been implementing more at this point. There's some law changes that are happening with estate taxes, income taxes. There's some rules that are going to sunset the end of 2025. You may remember what they call the tax law cuts.
The Jobs Act,
yes,
the TCJA.
And so, exactly. And so those are going to sunset the end of 2025. And we're likely all going to be paying more in taxes. But one of the things that's affected is also the estate tax exemptions are going to go down significantly to probably around $7 million. And so for anybody who's got a bigger estate, this becomes really something that they need to have on their radar. And for clients whose estates are bigger, we're proactively planning and using the higher exemption now. So you could actually stash something like close to $14 million into a trust, allow your spouse to have access to it. And so it's called a Spousal Lifetime Access Trust, or a SLAT, another acronym.
Loving all these acronyms.
There's other ones that are out there. QPERTS stands for a Qualified Personal Residence Trust. It's a great way to have really a significant amount of your house value transferred to the beneficiaries, while allowing you to have the right to the house and to not have such a big amount used as your gifting amount. That's another type of a tool. Of course, credit shelter trusts between a husband and wife. You can have 2 exemptions of state and gift tax exemptions instead of just having one if the plan is planned the right way. Dynasty trusts, if you want to try to create generational wealth, having it go from generation to generation without having it be taxed at every generation, that's another aspect of planning that we can incorporate for the client.
And for clients that are philanthropically inclined or want to leave a charitable type of plan behind, if they have an asset that has greatly appreciated that they are looking to sell but don't want to pay capital gains on that at this point, they can create a charitable remainder trust, which we've used over the years to help clients get a tax exemption.
Yeah, actually, I can give you we've used it many different times, but I can give you one specific example of one where it's helped out quite a bit. We have a client family that we manage a good amount of money for them. There's a bunch of real estate that over the years we had transferred into irrevocable trusts, and they've grown in value but we kind of froze the value of that gift back when we made those transfers. And so it's a real estate family. They've made a good amount of money doing that. But as they're getting older, they're slowing down with their real estate. And the next generation no longer wants to be involved in that space. And so the generation that we're working with, the clients, have decided to start selling some of the real estate. And of course, with that, it's causing a lot of capital gains. And so what we were able to, and one year the client came and said, hey, I've got about $1.5 million in gain. Is there anything that I could be doing this year to mitigate my taxes? And so we talked a little bit about what they wanted to do moving forward. And they were like, we need to start selling some of the real estate. We're going to be selling some more next year. And so what we've decided to do is to take some of that real estate that they were going to likely sell next year, put it into a charitable remainder trust. And the idea there is that I'm giving a part of it, the remainder interest, and that could be as little as 10% to a charity, and I get that deduction today. And so they were able to get that deduction to offset the current sales that they already recognized when they sold the property and have this big capital gain tax.
Do you mind just explaining how you get the annual payments from the remainder, from the charitable remainder trust, or CRT?
Yeah.
We love those acronyms.
Right. So it can be set up in a number of different ways. In that particular one, what we did is we set it up where the grandkids are going to receive, actually not individually, but they're going to receive it into trusts for the grandkids. On an annual basis, they're going to receive a payment, an annuity payment. And so that will be for the next 20 years.
Wow.
And that money can then be reinvested. And so they'll have money for college and other things to buy their first home and all of that from that money. Grandparents got a big charitable deduction up front that offsets some of the capital gains that they had to pay. And then whatever is left after that 20-year period, or when the grandparents pass, that goes to the charity at that point.
In that specific situation, was that annuity payment considered a gift? And was that also used to minimize the estate tax?
So the present value of that annuity payment is considered a gift to the grandkids. Yes, and that eats away at their estate exemption, but all of the growth that happens on that money is going to be outside of their estate. And it also had another benefit of having that income that's generated through those payments and through that money actually be deferred to the grandkids that are in a much lower tax bracket than the grandparents. So sort of a win-win on multiple fronts, and took some time to put together, but it's
financial ninja again.
So it's the way to help address some of that, and that really comes from understanding the client's financial goals, their estate planning goals, and really having more deeper conversations, getting to know their kids, grandkids, and seeing what we can do on a more global way of planning for that family.
So that was especially possible in this situation because you also manage some of their assets, but you also, in addition to that, have a very strong real estate background of your own. So the combination of the two must have really allowed you to have a much stronger impact on them.
Yes, and let me say that in that particular case, I've learned just as much from that family in terms of real estate investing as I have from any other clients. But yes, I do. We as you know, we invest in real estate significantly along with equities, and it helps to better understand what a family is needing to go through when they're doing real estate work, and understand some of the benefits and the tax benefits and implications of what they're doing, leverage and all of that. So that holistic kind of background is, I think, beneficial for these kinds of clients. All right, we have some other questions. From your perspective, you do a lot of the estate planning law work for our clients. You also tend to review some of their financials because you're helping them make sure that everything is put in the right place. Maybe you can talk a little bit about how does that coordinate with with what you're seeing their financial plan is, and when they're coming to us? Are you seeing that things are lock in step with their estate plan, or are you seeing that things are different? And what are some of the ways that you've come up with to fix that for them?
When clients often come in to see us, they typically either have no estate plan in place or some sort of an older estate plan. But I often also notice that their financial plan does not coordinate with their estate plan. They don't really realize whether they have any beneficiaries listed on some of their documents or that things have not been updated. One of the things that we help them do is really review their financial goals and what their financial plan looks like to make sure that it works well with their estate plan.
Okay. Can you think of an example of where that coordination really helped?
Well, I can think of an example of where that coordination or was missing and it didn't help.
That's even better.
We had a client, actually before we started the financial firm that came to us, her stepdad had passed away. I don't know if you remember this one. And he had listed his stepdaughter as beneficiary on most of his documents, but he left out on his $750,000 retirement account, where it was very clear that he wanted to list her, but he had never updated those forms. And unfortunately, that account went to his father that he hadn't spoken with in over 40 years.
Oh my goodness.
And that was absolutely heartbreaking to see.
I remember that. It was with a large financial institution. He actually worked for that financial institution.
He did. And they believed that he had filled out the forms and sent it in, but that he was missing a signature.
And it's very possible. I probably still think that he did, and that the institution just didn't have it. It wouldn't be the first time that I've seen that happen. And it's unfortunate. You want to make sure that you have copies in your files of all the beneficiary designations, because you can't trust that that's been updated. You have to verify that that's been
Absolutely.
the case. And that's why in our financial planning practice, we review those designations with our clients every year.
That's critical.
So one of our appointments is always about, let's review beneficiary designations. We certainly go over that. I can think of a couple of other cases. So often in our estate planning and elder law practice, where we're helping clients set up their estates in such a way that it protects it from long-term care expenses. Okay. And as an attorney, you're telling them, okay, I want you to retitle. You might have stock at Con Edison and it's in book form, and you're saying, go ahead and retitle that. Or there might be a brokerage account and you say, retitle it into the trust. By the time they get to the financial advisor, I've certainly have seen, let me know if you've seen that, but I've seen where the financial advisor says, oh no, let's just name the trust as the beneficiary. And they do that thinking that everything is okay. And then years later, when that client is in need of some help on long-term care issues.
So let's just clarify. They're not naming the trust as the owner as they're supposed to. They're just naming it as the beneficiary.
Yeah. That's not retitling the ownership into the trust is key in that situation.
Absolutely.
And those are the instructions that you give the client. But then the execution of that, when they go back to the financial advisor, doesn't always happen that way.
Right.
Because the advisor is now trying to be the estate planning attorney and to say, well, that accomplishes the same thing. The reality is that they haven't had that deeper conversation with the client and understood all the mechanisms and tools and that the attorney has helped. And I got to tell you, when I took my CFP exams, I remember going through this where I went through a course to prep for the exam. And I'm there in class, and we're covering long-term care expenses and Medicaid planning and all of that. And it was surprising to me how little the financial planning industry knew about really long-term care planning. Other than selling a long-term care policy, they didn't really know about all the kinds of tools that elder law attorneys and estate planning attorneys know. And it was sort of having to educate them about this is what we do as estate planning and elder law attorneys, and there was a bit of a disconnect there for them. And for me, I was thankful that we have the background of both estate planning and financial planning to be able to really create a more comprehensive plan for a client.
Right.
And that's why it's so amazing that we have everything that we can do in-house together. We have that marriage between both an estate planning and a financial advisor, but also attorney. But between the two firms, there's that ability to synchronize together and have that deeper understanding of a client's holistic picture.
Absolutely. A lot more synergy when you have a better understanding of all the different aspects for a client. And you're looking at it, I often say that estate planning attorneys might live here and financial planning attorneys live here. We sort of live in that middle area where we have a better understanding of both of those things.
Saving that client millions of dollars with CRTs would not have been possible if you didn't do both aspects for them.
Probably not, because I probably would not have had the kind of deeper conversations with a client on an ongoing basis and wouldn't have understood. In that particular case, we also saved that client because we were harvesting losses that year in a significant way, and we were able to offset some of the capital gains. So there's a lot of synergy when you can do both. Absolutely.
And so, Michael, I'd love to have you explain a little bit about how you help clients on the financial side and the fact that you look at their tax returns and help them with the tax planning side as well.
Yeah, I'm often amazed how financial planners don't review a client's tax return. If you're going to make a financial decision about something, taxes are the first thing that would be impacted. And so you'd certainly want to take a look at a person's income tax return. And so in our practice, we certainly do that on a regular basis. Typically, when it's time for them to file their taxes, we're reviewing to make sure that it was filed correctly. And then we're doing tax planning with a client. So we're looking at things proactively to say, okay, you've got different types of accounts. Where would be the best place for you to pull money from? Maybe one year it might be from one place, another year might be from another place, because things have changed for you or because you've had that big capital gain kind of situation. There may be opportunities to do Roth IRA conversions. People often don't know that they can do that, or they might be able to harvest losses and carry those forward until a year that they need to sell those. They can write off $3,000 a year in the interim every year. So there's a lot of different techniques and tools that we can use to really do tax planning. I say, well, doesn't my accountant, doesn't my CPA do that? And the reality is that most CPAs or accountants are reporting what's already happened last year. They're filling out your tax forms and saying, okay, you've had this much in W-2 earnings, you've had this much in K-1 distributions, your company made X amount of dollars, and they're reporting that information on there rather than saying, here's what we can do to minimize the taxes. Because what's happened last year, you can't do anything about anymore. Mm-hmm. You can only do things moving forward during this tax year and in the future. So that's the kind of work that tax planning can do for the client, and that's what we incorporate.
We often tell clients that many financial advisors are just concerned with making your accounts money. And that's great.
That is a good point.
That is, but we're also concerned about saving clients money on their taxes and other ways.
Yeah. There's absolutely, it's a two-prong approach. It's not just about helping the client grow their portfolio, which is really important.
That is, it's a key pillar of it.
Absolutely. But also, how do we do it in the most tax efficient way? I'll give you another example. We just had a call with a client's family. We had worked with this client since 2010 on the estate planning side. And for years, I've been telling them, we need to revisit with you the financial planning side. I said, look, we have an advisor. We work with them. Great. No problem. And we work, of course, with clients that have other advisors. That's fine. And so mom had passed away recently, and they were advised to liquidate the IRA. And so it was a relatively small amount, maybe $80,000 or $90,000. And why were they recommended to do that? It was because she had a lot of medical expenses. So the idea was, you're not going to pay a lot of taxes. Let's do it in mom's name instead of when the kids inherit it. Because when the kids inherit it, they would pay at a higher tax bracket. Yeah. And that makes sense.
It does.
Is there a better way to do it, though?
Yes.
Okay, let's hear it.
If you use Roth conversions,
Okay.
they would have been able to not have to pay it on, they would be able to do the conversion at a lower rate, but the kids could take it out tax-free later on.
That's right. So
and
they
can continue to grow.
Yeah.
Right. So they can actually have, so you would recognize that tax liability under mom's name that passed away. And then there wouldn't be any, or substantially a lot of the taxes would be written off because she had a lot of medical expenses. But then the kids would inherit a Roth IRA instead of just an account that was in their name. And on that account, if they invested, they would have to pay on the taxes every time that they earn dividends, interest, and so on, or capital gains when they sell it. Whereas if they had that Roth IRA, that money could have grown for another 10 years. At the very least, it could have doubled, if not more. And they wouldn't have had to pay another penny on it.
So that decision that they listened to,
it probably cost them 20 or
30,000.
At least. And that, for that family, that was probably what they would have paid me over the last few years. In turn, so just that one fix could have made them all that money in taxes that they would have saved. You live and learn, and so hopefully
you don't know what you don't know.
Right. And that's important that you say that, is because as a professional, I realize how much we don't know. And I would say that as a layperson, or as a person who's not doing this for a living, there's a lot. There's a ton of things that you don't know. And so you can't become an expert at everything. You need to hire the right experts to help you.
We don't fill our own cavities here, do we?
No, we don't. Not to mention, even when it comes to a real estate transaction, we're involved in a couple right now. We hire attorneys to help us do things because you need a little bit of distance. You need somebody to see things in a way that you're not seeing.
Even though I used to teach continuing legal education on how to do real estate transactions, both residential and commercial, we find the need to take a little step back, be objective, and have an attorney represent us.
What's the saying?
An attorney that represents themselves has a fool for a client. Something like that.
Probably a fool for an attorney as well.
All right. So let's move on.
I want to ask, what's the future direction you see estate planning moving in, and how would you say Davidov Law, Davidov Financial is keeping up and maybe even outpacing those trends?
Wow. So I feel like estate planning has become a little bit more heavy in two areas. There's a lot of people that want to do it themselves. And today with ChatGPT, a lot more people feel very empowered to do it themselves. But then there are a lot more clients that are seeing the need for having a professional help them to make sure that things are done correctly, because you don't know what you don't know. And who do you leave a mess behind to if you end up trying to do it yourself, or having a very inexpensive or cheap approach that doesn't necessarily solve your problem, actually creates more of an issue for you?
Yeah, I'd say I see the same kind of results. I would say that with a spectrum of different clients and different people that need help with estate planning, you have people that congregating in two different areas. One that is saying, I'm just looking for the least expensive, and maybe they're gravitating towards that in terms of price.
Price is a major factor for
for them is a major factor. And then you see a lot of people from the middle also moving to the other end of it, where they're saying, I'm looking for value, I'm looking for expertise, and we're seeing a lot of growth in that area. I think for our financial planning practice, we've grown quite a bit over the last decade or so. We're seeing a lot of growth in that area, and I think that clients really respond to that want to have a relationship. After all, who are you doing this for? You're creating an estate plan. You're creating a legacy. You want to have one place for your client one place for your family, to go to, and to be able to say, these are the folks that have helped me do this. They're going to be helping you
They'll be
address
there for you.
all of these things. Exactly.
But not only that,
it's hard to do that when you've created a document through a computer. Who's going to be there? It's hard to do that when you're the person who has been the guru in the family with stock picking. What happens when you're gone? Is your spouse going to be able
Well,
to
not even
do
when
that?
you're gone, when you're not able to make decisions for yourself.
Also, even some people, they say, it's whatever. I don't care. Let my kids or whoever deal with whatever mess I leave
Do you want
behind.
us to say that about it?
Definitely not. But there
No.
definitely are some people like that. We hear it all the time. Well, not all the time, but from time to time we hear that. But what they don't realize is sometimes if they want to do it themselves, they can actually leave a mess for themselves. If they become incapacitated, if they have some kind of medical decision they need made, if they did it incorrectly, that could create a lot of problems for not just them, not just their family, but also for themselves.
I have a great example of that. I'm just thinking of a case where I met this family after the parent had passed away, but the daughter, being an educated person, said, no, I can do this on my own. They understood the need to create a trust because a trust can help them avoid probate and make things a lot easier. And so she went online, she got through service a document template, put it together, signed the document, and never funded anything into the trust. And her dad passed away, and then she came to learn that the house wasn't in the trust, the accounts weren't in the trust. And so things had to be probated, which is exactly the thing that she was trying to avoid. And so then we had to administer the estate and probate it. And that's how we met them. And they said, well, why do we need to go through that? Well, because the titling of it wasn't done properly. She said, well, I didn't know about that. And that's exactly the point. You don't know what you don't know.
So I have another couple of examples. One example is of a family that came to us after the fact. Their parent had simply added them to their deed. They were trying to do the least expensive approach and to avoid probate. And when the parents added them to the deed, what did they do? They gave them their house at their cost basis. They had purchased the house.
What? Just for our viewers to understand, what do you mean by that?
Well, so when the parents purchased the house, they purchased it for $40,000. They maybe put a little bit of money into fixing it up over the years. And they then proceeded to add their children's names to the deed. The house was worth at the time of the parents' death about $900,000.
Right.
Wow.
And so when the kids sold the house, they then got hit with a very large tax bill because there was a huge capital gain. Had mom and dad planned things in a better way, had they left the house to their children through their will or through a trust, the kids would have gotten the house at fair market value.
The step up in the basis.
Right, with the step up in the basis after the parents had passed away. And then they would have sold the house and not been hit with these crazy capital gains. Yeah. I have another story, another situation. I remember that these prospective clients were looking to do Medicaid planning, but they didn't want to invest in a trust-based plan.
Okay.
The mom and two daughters came in to see me probably about 15 years ago, and I had recommended putting the house into an irrevocable Medicaid protection trust, and mom said, no, I don't want to spend the money on that. I'd rather just add my kids to the deed.
Okay.
And unfortunately, she did that, and not with us. I said that I wasn't able to help them. A couple of years later, one of the daughters called me and said, I wish we would have listened to you. And I said, what happened? Well, my sister passed away. My sister had a special needs child and no will.
Okay.
And my sister's husband and my mom don't get along. Well, guess who owns that house with mom now? The husband who...
That's bad karma.
Yes, it is. And so those are some reasons to make sure that you're getting the right advice and that you are moving forward with someone who's there to help you protect yourself and your assets for your family.
Yeah.
Without the right advice, a trust can just be a paperweight, you know? It really matters more how you incorporate everything with the right legal, financial, and everything together.
making sure.
Exactly.
So I wanted to ask you also, I think one of the gifts that you have is really being very empathetic and very compassionate about the work that you do. And
I love what I do.
It shows.
it absolutely does. I think I hear that from our clients all the time. What makes a good estate planning attorney? In terms of your background, you seem to have the right combination of things to help kind of nurture the relationship with a client and to help navigate through difficult times, perhaps as they're getting older, and then down the road when the family has to address when somebody passes away or when they get sick.
Of course. So I don't think it's the documents. So if somebody thinks that they can go and download the documents without the counsel really means nothing. So it's making sure that you make a connection with the family, that you are listening to what their goals and what their wishes are, what they'd like to see happen, because I can see two different families that seem on paper to have the same circumstances, but in reality, the planning for them might be very different. You really need to understand their goals and concerns and what they'd like to see happen. And then we can put that into the plan and make sure that the plan is there working for them. And I think what I love more than anything is being there for the families when there is a situation, when something comes up, that we're able to be here and help the family through whatever hurdles they have because somebody is incapacitated and is not able to make decisions for themselves, or somebody has passed away, and we want to make sure that we're helping the family really move the plan along and make sure that there's no mess, that there's no family drama that happens, and that things flow the way that our clients wanted them to. And that's very important.
Absolutely. I certainly have seen that clients feel very at ease with you and have an ability to, that you have an ability to communicate with them and to really understand them very well and to be compassionate with them. And they seem to open up to you.
Thank you. Well, I treat them the way that I want someone to treat my parents.
Right.
Yeah.
That's really what shines about our practice, is we really are here to help our clients and to give them the direction and the help that we want someone to give our parents under a similar circumstance.
I recall that during COVID, such a difficult time, I think, for a lot of people, a lot of clients in particular, just being in isolation, particularly if you're older, if your health has been compromised. And I recall that we've had one client where she was in an assisted living facility and got COVID and needed to go to, she went to the hospital first and then went to a small nursing home, and how difficult it was to communicate with that nursing home. It was as if they didn't want to let her out.
They didn't.
And
it's very profitable for them to keep her there.
Yes, it was.
And just really how you and our firm have been there for that client and really ensured that her best interests were seen.
And I recall a family who called because the funeral home or the cemetery wouldn't dig up the grave to get ready for a funeral, and you had to get on the phone with the person in charge. I don't know if you remember this situation.
Yeah.
And we've had to do some pretty amazing things to help our clients at difficult times.
Every time I meet one of your clients, whether it be a newer client or one from 2010, 2009, and the longer they've been involved with you guys, the more amazing things I've heard that you've been able to do for them, how much you guys have been there for their families. In one of the videos that we had done, one of the clients really described it perfectly. They say, when you guys are talking to the clients, you don't treat them like they're a client necessarily. You treat them like your friends. And I think it shines through friends or even family, and I think it shines through, and everybody feels that warmth coming into the office.
Yeah, I think more than anything, this is really about creating, as we said, high value. Clients really want that connection, that relationship, and to know that we will fight for their rights and for their family and for their legacy as much as we can. And I think that shows in those interactions that we've had with the clients for sure.
So one last question to finish it off.
Yeah.
For each of you guys, what advice would you give to someone considering starting the estate planning process, whether it be at our firm or a different firm? What's one piece of advice we can give?
Make sure that you're working with a firm that focuses on estate planning and elder law. And if they understand the financial side as well, that's an even bigger plus. I sometimes review documents of clients where they initially started with a different firm, and it's just day and night difference. Those are just documents. You have to make sure that the people you're working with, they know what they're doing and that they're there to help your family through a difficult time.
So you're specifically referring to these types of jack of all trades attorneys. One day they're doing a divorce, the next day they're bailing someone out of jail, and the next day after that they're writing an estate plan up.
Yes, absolutely.
Yeah, I would say that the larger the estate, if you're dealing with like $500,000 or less, most attorneys likely be competent in drafting a will to do that. But when you're dealing with more assets and you're looking for a relationship-based firm that's going to help navigate as you get older, and that you want somebody to be there for your family that's really focused on this area of law, that has expertise, you want to pick somebody that has a focus on estate planning, elder law, and financial planning if you have the ability to coordinate all of that.
Absolutely. And even for that smaller estate, the $500,000 estate, if the attorneys don't know to ask the right questions, if they don't know to ask the client about Medicaid protection, long-term care protection, then they're not going to necessarily build the best plan for that client.
Yeah. It's a stark difference between those firms that focus on this area that have really the skill set to navigate through this and to do more counseling oriented work rather than document drafting kind of work. I remember years ago we had a paralegal that came to us from a firm that did a lot of different things. It was a large firm, but they would basically send out a questionnaire to a client or a prospective client and say, fill this out, and they'll populate it into a form template. And I thought, how strange is that the attorney isn't taking the time to really understand what the goals of the client are. There's no counseling.
Yeah.
And it's just a document production place. And that firm did a lot of probate work because they were in the business of just churning out
Trust
a lot
mill.
It wasn't a trust mill. It was a lot of will-based plans.
A will mill.
I guess so. But it really should be something where you're counseling the client, better understanding what their needs are to then make the appropriate recommendations. Not every client needs the same kind of estate plan. Certainly not two estate plans should look the same. Everybody has a unique situation.
Right. And clients, when they're coming in, they oftentimes don't know what they need. They might have heard the word will or trust, or they might have heard some terms. But most of the time, if they're coming in and telling me, oh, I need a will, I'll ask a few questions and we'll get very quickly to a decision that perhaps they need more than that, depending on what their goals or concerns are. And they don't know what they don't know.
Right. So it's important to go through that and to better understand what their goals are. For sure. Great. Well, let's wrap this up. What's the one key takeaway that you have from your clients about the estate planning process? What do they tell you after? What do you hear a lot of?
That it wasn't as hard as they thought it was going to be.
Okay. Why do you think they perceive that it's hard to get accomplished?
They are so worried about speaking about potential death or incapacity that they avoid doing it. And we have such a wonderful process in terms of going through what their wishes would be, that before we know it, that we're done. And they're like, wow, I can't believe I just did that. And usually when we're signing the documents, kind of we reach a place where I feel a huge sigh of relief. And I say, oh, what was that? They're like, I can't believe I did this. I can't believe I got this done.
Okay.
And so it's
a positive experience.
It's a wonderful experience.
What about you?
I think for us, what I hear often is that we have a process in place that helps guide people through. And so I've got a more technical background, so I appreciate that, knowing that, you've got a very developed step-by-step process of how to take a client from where they are, maybe afraid about getting this done, to a place where you can help them get organized and take them through this process. And at the end, they have everything that they want accomplished, and then they have the reassurances that their family is going to be taken care of. So for me, that's the most fulfilling thing. That's what I hear from clients often.
Absolutely.
That's what makes it all worthwhile.
Yeah.
Absolutely. And with that, let's end it. Thank you for joining us for this.
Thank you.
For this podcast.
Thank you so much.
Okay.